Hello, everyone. All right. Today we're going to learn about a P&L and how to read a P&L statement. P&L stands for profit and loss, and that's how you measure how a company is doing. So anybody who owns a company should have P&L reports that they go through. And what a P&L report contains is a company's income and expense information for a specific time. You can do a P&L for a month, you can do it for a quarter, you can do it for a full year. All of those are very common and very natural. A P&L report specifically breaks down revenue and expenses and measures whether a company is profitable. Quarterly profit and loss statements compare current information against projected budgets. So every year you're going to project what you want to have happen, and the current information tells you whether you're doing well. So a company can track whether it's on pace for a profitable year or a bad year and how it's performing compared to previous years. So companies can also track their income and expenses on a weekly or a monthly or a yearly basis. And the components of a P&L statement is revenue, cost of goods sold, and some people call that COGS. It's spelled out COGS, cost of goods sold, gross profits, operating expenses and income, other income and expenses, net profit. And then the formula for a P&L, and I'm going to show you a P&L in a second, is revenue minus expenses equals net profit or loss. Okay. So again, revenue minus expenses equals net profit or net loss. All right. I'm going to show you an example of a P&L. So I'm going to share the screen, and you're going to see, you should be seeing now a P&L. And so as we look at this P&L, you will see at the top, this is a 3-month P&L rolling, February through April 2023 of a restaurant. Okay. Your P&L starts with your income. Okay. And it breaks into profit. So in this particular example, you have February of 23, March of 23, and April of 23. And it shows percentage of income. You've got your lunch sales. So here it's showing 124,000 in lunch sales in February, 112,000 in lunch sales in March, 105,000 in lunch sales in April. And you've got your dinner sales, same thing, 148, 146, 122. And then you've got your total income. If you go down, total income for February was 271, March 259, April 228. You have your cost of goods sold. So in a restaurant, you have food costs, you have beverage costs. Your total cost for February was 76, 69, 61. And your gross profit, remember, revenue minus expense, in this case, cost of goods sold equals your profit, 194 in February, 189 in March, and 166 in April, with your total February through April of 550,900 for gross profit. However, don't get fooled by that's not all. You have expenses too, right? So in a restaurant, you have expenses of disposables like plates and napkins. You have labor expenses. BOH stands for back of house labor. FOH stands for front of house labor. Okay. And you have all of these expenses. You have salary for hourly people, salary for management. You have payroll taxes. You have other expenses, marketing, and all of this rolls into, on the second sheet, the total cost. Okay, so your total expenses on a P&L in this particular example for February was 190,000, March was 177,000, April 141. This looks good, doesn't it? Because you have high expenses in February and it keeps going down. Your total expenses February through April was $509,000. Now, you take your revenue, your gross profit, 550,900, less your total expenses, 509, and you have a net ordinary income. Remember, revenue minus expenses equals your total profit or loss. In this example, it's a total profit of 41,000 or 5%. Okay. Which is, are we doing bad or are we doing good? If you look at it, you see February was 1% of net profit, March was 5%, April was 11%. It looks like this restaurant's starting to get a handle on things. Over the 3 months, you're at a total profit of 5%. Okay, now that is an example of a P&L. P&Ls are so very important for us all to watch. Me as a business owner, I'm looking at my P&L constantly. At minimum, you should be looking at your P&L every month. A good business owner will look at it as at that minimum or more. Okay, so you have to have an accounting group that will help put that together, or you're going to have a controller or someone who's doing your QuickBooks if you're a small business. The business I showed you, by the way, has about 60 employees. Can a person who has 2 employees do a P&L? And should they? Absolutely. A profit and loss statement is the way that you are able to watch and see how your business is doing. And any business owner must and should be looking at their P&L statements constantly. All right. I hope that this has been a good beginner's overview of P&L. And I thank you so much for letting me be a part of this. Okay. Take care now.